The widening conflict in West Asia is generating an economic fallout that is now directly impacting Indian consumer prices and industrial margins. Iran's foreign minister, Syed Abbas Araqchi, has announced that Tehran is permitting only friendly nations, including India and China, to use the Strait of Hormuz, while blocking vessels linked to its adversaries. This choke point handles roughly 20% of global oil and LNG flows. Access Bank analysts warn that if the strait is not fully reopened by mid-April, the global economy will enter a recession. Domestically, edible oil prices have already climbed by 15%. Financial markets are reflecting this instability. Foreign portfolio investors have pulled 1.25 trillion rupees from Indian equities this year, with derivatives traders now positioning for a volatile Nifty range between 22,750 and 23,850. The blockade in Hormuz has transitioned from a geopolitical risk to a direct driver of domestic inflation and industrial margin compression. The center is maintaining a 4% medium-term retail inflation target, despite these external shocks. However, policy attention remains focused on imported energy costs, which threaten to push inflation back above the government's tolerance band. To bypass rising global freight premiums, Indian importers have shifted edible oil sourcing toward China. Between November and February, soybean oil imports from China rose significantly, offered at a $60 per ton discount compared to South American suppliers. Macroeconomic forecasts are reflecting these disruptions. Goldman Sachs and local economists have set India's 2026 growth projection to 5.9%, citing higher energy prices and the trade bottleneck in Hormuz. India has also reset its interim climate milestones. While the 2070 net zero goal remains, the 2035 target for non-fossil energy share has been raised to 60%, reflecting a harder phase of decarbonization as energy demand grows. Economic policy is currently prioritized towards managing immediate supply disruptions and energy-driven inflation. While macro forecasts slow, India's corporate sector is aggressively deploying capital into high-growth, high-margin sectors. Infosys has reported its largest acquisition year ever, spending $808 million to strengthen its cloud and AI capabilities. This includes up to $465 million for Optimum Healthcare IT and $95 million for Stratus. In the consumer market, Subway India is preparing a $150 million IPO. This comes as the Nifty's valuation premium narrows, the B index trading below 20 times trailing earnings for the first time since 2020. Defense manufacturing is seeing rapid expansion. Solar Industries reports an 18,000 crore rupee order book for systems like the Pinaka launchers, with management planning 12,700 crore rupees in drone investments over the next decade. Sports franchise values also continue to climb, illustrated by the sale of Royal Challengers Bengaluru to an Aditya Birla-led consortium for approximately $1.8 billion. Corporate capital is concentrating in AI, defense, and consumer franchises, largely bypassing broader market corrections and macro headwinds. A Mint editorial suggests that India's revised climate timetable reflects a complex balancing act. The country must now sustain industrial growth and rising energy demand while meeting increasingly difficult decarbonization targets. Market closing numbers show a flat session for equities. The Sensex finished at 75,273, while the Nifty 50 held at 23,306. The rupee remains steady at 93.97 per dollar, but oil prices climbed by $1.46 to settle at 98.69. Energy security and freight stability will remain the primary factors determining India's economic trajectory entering the next quarter.